So have you ever had that exact moment where you check your investment portfolio on your phone and your stomach just like instantly drops?
Oh, I think every single investor knows that exact feeling.
Right. You're looking at this sudden terrifying cliff on the chart. Like thousands of dollars have seemingly just evaporated into thin air.
And it happens so fast, too.
Exactly. You panic, you refresh the app, maybe you force close it and open it again, and then mysteriously the numbers just bounce right back to normal.
Like nothing ever happened.
Yeah. And you probably let out this huge sigh of relief, and you tell yourself, well, it's just a weird glitch. But what if it wasn't a glitch at all?
Right, because the data says it usually isn't.
Right. What if that momentary heart attack was actually a perfectly engineered event designed to, like, shake you out of your positions?
It's deeply unsettling when you actually look at the raw data behind those moments. Because, we tend to think of the market as this organic reflection of human buying and selling.
Like a collective agreement on what a company is worth, right?
Exactly. But the sources we're unpacking today, which is this massive stack of forensic market data and advanced research on market microstructure, they reveal a completely different environment.
Yeah, it's wild.
We are essentially looking at the anatomy of algorithmic predation.
Algorithmic predation. Just the phrase sounds like sci-fi.
I mean, it kind of is.
Yeah.
This is the architecture of high-frequency trading, where these supercomputers are programmed to harvest retail investors' money in, like, fractions of a microsecond.
And that is exactly our mission for this deep dive.
Yeah.
We are going to peel back the curtain on how those invisible digital predators operate. Like, we're going to walk through exactly how they manipulate perception to force a panic.
It's a fascinating process to break down.
But to start, I think we need to abandon that movie version of finance, right?
Yeah.
We aren't talking about guys in tailored suits yelling on the floor of the New York Stock Exchange. So where is this actually happening?
Well, the physical location is honestly surprisingly mundane, but the physics involved are extraordinary.
Okay, lay it out for us.
So the sources outline this very typical, highly documented scenario. It's an ordinary Tuesday, exactly 2:32 p.m. Eastern Standard Time.
Just a random Tuesday afternoon.
Right. The broader market is flat. There's no breaking news, no unexpected earnings reports. Regular retail investors, people like you listening right now, are just completely relaxed.
Sipping coffee, maybe checking their apps.
Exactly. But the ambush is already being prepared inside these massive, highly secured, windowless server farms in Mahwah, New Jersey.
Okay, Mahwah, New Jersey. Not exactly the glamorous financial capital of the world.
No, not at all.
It's basically just a warehouse off the highway.
Yeah.
So why are the most sophisticated financial machines on Earth sitting in a New Jersey suburb?
It literally comes down to the speed of light in a vacuum versus the speed of light in a fiber optic cable.
Wait, really? It's about physics.
Pure physics. Mahwah is geographically as close to the New York Stock Exchange matching engines as physically possible.
Oh, I see.
So high-frequency trading firms, or HFTs as they're called, they pay exorbitant rent just to place their supercomputers literally feet away from the exchange's servers.
And there's a term for this, right?
Yeah, the industry term is co-location. The entire goal is to shorten the physical length of the fiber optic cables connecting their machines to the market.
So they just want a shorter cable.
Exactly. Because by reducing the physical distance that the light has to travel, they can shave off fractions of a millisecond in communication time.
Which is, I mean, that's pretty humbling, you know? Like, I'm sitting at my kitchen table feeling incredibly smart because I drew a trend line on my portfolio app.
Right, doing your little technical analysis.
Yeah. And meanwhile, a billionaire fund is spending millions of dollars just to cut 100 feet of cable out of the loop just so they can beat my trade by 1,000th of a second.
It's a totally different game.
So, okay, it's 2:32 p.m. These hyper-fast machines are sitting there in the dark, waiting. What kicks off the ambush?
Well, the machines are just constantly scanning the data feed for these minute vulnerabilities.
Like looking for a crack in the armor.
Yeah. And in the forensic case file we're looking at, the algorithms detect a very slight, completely natural downward pressure on a major exchange-traded fund.
An ETF.
Right. Just normal market breathing. Someone, somewhere, sold a few shares. But the bots use that natural dip as the ignition point to manufacture a total illusion.
Okay, hold on. How do you manufacture a fake panic? Like, if the market is just breathing normally, how does a computer trick everyone into thinking the sky is falling?
So the tactic is called spoofing.
Spoofing, okay.
The algorithms connect to the National Best Bid and Offer System, the NBBO.
And the NBBO is, what exactly?
You can think of it as the central nervous system of market pricing. It basically broadcasts the highest current buy price and the lowest current sell price to the whole world.
Okay, so it tells everyone what the going rate is.
Exactly. So the bots suddenly flood this system with thousands upon thousands of massive sell orders, just a fraction of a cent above the current market price.
Wait. If placing 1 million sell orders tanks the price of an asset, aren't they just, like, shooting themselves in the foot?
How do you mean?
Well, if someone actually buys all those shares, the HFT firm is suddenly short millions of dollars on a stock they didn't really want to sell.
Right, and that would happen if the orders actually stayed there. But they have absolutely zero intention of executing those trades.
Well, they don't?
None. The algorithm is programmed to place this massive, terrifying wall of sell orders and then instantly cancel them within 1,000th of a second.
A millisecond.
A single millisecond.
So it's humanly impossible to react to that.
A human trader wouldn't even see their screen flicker,
Wow.
but the other computers see it. For that 1 millisecond, the rest of the market's infrastructure registers this overwhelming supply.
Right. The computers are fast enough to catch it.
Exactly. The perceived number of shares for sale vastly outstrips the perceived demand. So the data feed essentially screams that massive institutional holders are dumping their positions in a total panic.
Okay, let's unpack this. It's like someone yelling fire in a crowded theater just long enough to make everyone sprint for the exits.
It's a great way to put it.
But there's absolutely no fire. Or, it's like placing a massive, terrifying bid on a house at an auction just to scare away all the other buyers.
Right, and then pulling your hand down a millisecond before the auctioneer's hammer actually drops.
Yes. It's purely psychological manipulation. The psychology being manipulated belongs to other algorithms and, like, automated trading platforms.
Exactly.
But if they cancel the orders so fast and they don't actually sell anything, what is the whole point of creating this fake supply?
They are hunting.
Hunting for what?
For the invisible safety nets that retail investors leave lying around the market.
Oh, you mean like stop losses?
Exactly. When you buy a stock on your app, the conventional wisdom you're taught is to protect your downside, right?
Right. You place a stop loss order.
Yeah, you tell your broker, if the price of this asset ever drops by 10%, automatically sell it so my account doesn't get completely wiped out.
Yeah. I mean, I do that all the time. It feels like responsible investing,
Sure, it's what everyone is taught to do.
I set it at a clean round number, like a 10% drop, and then I just go about my day knowing there's a floor under my risk.
Yeah.
Are you saying these machines are specifically looking for my responsible safety net?
The data strongly suggests they absolutely are. To a high-frequency trading algorithm, those safety nets are basically giant glowing targets.
Man, that's annoying.
The machines know exactly where these clusters of stop-loss orders sit because retail investors are incredibly predictable.
Because we use the round numbers.
We use round numbers or we place them just below obvious technical support levels, like a 50-day moving average.
Right, the stuff you see on every standard stock chart.
Exactly. The bots map out all these retail pain points, and the spoofing artificially drives the price down just enough to tap that very first layer of stop-loss orders.
Okay, but if my stop loss triggers, it just sells my shares at that price. How does my little safety net getting triggered lead to a massive market crash?
Well, it comes down to the mechanics of how the broker handles your specific instruction.
Okay.
When your stop-loss price is hit, it automatically converts into what is called a market order.
Meaning what?
It instructs your broker to sell immediately at whatever the best available price is on the book. It doesn't negotiate.
Oh, this dumps it.
Right. So the spoofing pushes the price down a fraction of a percent. The first cluster of retail stop losses is triggered. Those turn into automated, aggressive market sell orders.
And all that real selling hits the book.
Yes. All at its sudden, real selling sweeps the order book, taking worse and worse prices, which pushes the value of the ETF down even further.
Which then hits the next guy's stop loss order sitting slightly below mine.
Exactly.
And then the next one, and the next one. So it's just a domino effect.
A very violent domino effect. In the specific case file detailed in the research, the machines tapped the first layer, and in the span of exactly 3.4 seconds, this major diversified ETF dropped an astonishing 7%.
7% in 3 seconds.
3.4 seconds, yes.
I mean, for a broad market index fund, a 7% drop is the kind of catastrophic event you usually only see during, like, a global financial crisis.
Like a major bank failing.
Right. And here, it's happening in the time it takes to blink, all because some computer in New Jersey canceled a fake order. That is insane.
It is. And the fallout is that regular people, we're talking pension funds, retirement accounts, retail day traders, they are forcibly ejected from their positions.
Because their safety nets function exactly as they were programmed to.
Exactly. But because the cascade was so fast and so deep, their shares were sold out at the absolute rock bottom of this algorithmically induced dip.
Wow. But wait, I have a question about that.
Sure.
I understand how they forced the price down. But if millions of retail shares are being dumped via these triggered stop losses at fire sale prices, who is actually buying them?
That is the million-dollar question, or billion-dollar, really.
Right, because for every seller in a market, there has to be a buyer. So who is scooping up all this wreckage at the absolute bottom?
The very same algorithms that initiated the spoofing and caused the crash in the first place.
Wait, seriously?
Yes. The instant that wave of retail market sell orders floods in at those heavily discounted prices, the HFT bots pivot.
They just flip their strategy.
They cancel the last of their fake sell orders, and they deploy massive, real buy orders to absorb all those cheap shares.
But wait, how is that physically possible? If a massive wall of buy orders suddenly hit the New York Stock Exchange, wouldn't all the other brokers and trading systems, like, see it?
They would.
Wouldn't that public demand immediately stop the price from crashing?
It absolutely would if they were doing it on the public exchange.
Oh, I see.
The key to the harvest is that they don't buy the shares in the light. They absorb this retail wealth through what are called dark pools.
Dark pools. Okay, I've seen that term in financial headlines, and it always sounds incredibly nefarious, like some secret society.
It does have a very cinematic name.
Yeah. So what exactly is the mechanism of a dark pool? How does it intercept a trade that I make on my public brokerage app?
So a dark pool is essentially a private financial exchange. They are these trading hubs operated by massive institutional banks and wholesale market makers.
Okay.
When you hit sell on your retail brokerage app, say, one of those platforms that offers zero commission treating your order doesn't usually go straight to the NASDAQ.
Right, because if it's free, you're the product.
Precisely. Your broker frequently routes your order to a wholesaler first. This is a practice known as payment for order flow.
So my broker sells my trade data to a middleman.
Yes, and that middleman often operates a dark pool. And unlike public exchanges, dark pools are not required to display their order books to the public prior to the trade being executed.
Man, that feels like a huge advantage.
It is. The high-frequency trading bots are sitting inside these private networks. When your stop-loss triggers and becomes a desperate market order, it gets routed into this private plumbing.
And the bot is just waiting there.
Yep. The HFT bot steps in, buys your shares at that 7% discount, and the transaction is matched entirely off the public books.
Here's where it gets really interesting. They are essentially buying my discounted shares in a private back room before the main stock exchange even knows I'm selling.
That's a perfect way to visualize it.
It's like we aren't playing chess against a grandmaster here. We're playing poker against someone who has a mirror behind us and can change their cards at the speed of light.
That is exactly what it is.
They cause the panic in the public square, but they buy the dip in absolute secrecy.
And it is a brilliantly designed extraction mechanism, because once they have your shares, the broader market rapidly realizes there's no actual crisis.
Right, because there was no bad news.
Exactly. The original sell-off was completely artificial. It was driven by canceled spoofing orders, not by fundamentally negative news about the economy.
So the fire alarm just stops ringing.
Right. And over the next 6 minutes, the market aggressively corrects itself. The price starts climbing right back to where it was at 2:31 p.m.
Okay, and as the price normalizes, what do the bots do with all those shares they just bought in the dark?
They slowly and quietly sell them back onto the public exchanges. They capture this massive arbitrage spread.
So they just pocket the difference.
Yeah. When you look at the chart for that 10-minute window, it just looks like a severe V-shape, a sudden plunge, a sharp recovery.
A glitch.
A glitch. But the damage is permanently locked in for the retail investor. They sold at the bottom, and the bots extracted billions in profit.
Okay, this is where I get frustrated. If the manipulation is this blatant and the forensic data you're citing lays out the timestamps and the order flows and the dark pool routing so clearly, Why isn't the Securities and Exchange Commission stopping this?
It's a fair question.
Isn't their entire mandate to protect the retail investor and maintain fair markets?
Well, the structural reality is that the SEC is heavily outmatched.
Outmatched how?
They are a traditional bureaucratic regulatory body, and they are trying to police a digital battlefield that changes state every single microsecond.
Yeah, bureaucracy doesn't really move in microseconds.
No, it doesn't. To investigate a flash crash like this, the SEC relies on a system called the Consolidated Audit Trail.
And is that essentially just a giant digital receipt of every trade that happens?
More or less, yeah. It tracks every order, every cancellation, and execution. But the sheer volume of data is staggering. We are talking about petabytes of high-frequency order book data.
Petabytes. So it's just a mountain of noise.
Exactly. It takes the regulators months just to reconstruct the events of a single 10-minute window and actually analyze what happened.
Wow. So the cops are essentially looking at a robbery from 6 months ago, and they're trying to dust for fingerprints on a digital file.
That's exactly it. And by the time the SEC fully understands how a specific spoofing algorithm manipulated the market on, say, a Tuesday in March, the quantitative analysts at the hedge fund have already retired that specific code base.
Oh, because they've already updated it.
Right. They've moved on and deployed a completely new, infinitely more complex model. The weapon they used is already obsolete.
That's incredibly frustrating.
And furthermore, the sources point out a really uncomfortable conflict of interest.
What's that?
The exchanges themselves, the institutions that are supposed to be the neutral ground for capitalism, they're actually profiting from this behavior.
Wait. Oh, because of the co-location fees we talked about earlier.
Exactly. The warehouses in Mawa.
Right.
The exchanges make hundreds of millions of dollars selling that preferential high-speed access to the highest bidder.
So they're literally profiting from the infrastructure that enables the predation.
They absolutely are.
But the research highlights a staggeringly simple fix to all of this, doesn't it? Like, it wouldn't even require new technology.
No, it wouldn't.
If regulators just mandated a universal minimum resting time for all orders, say, forcing an order to remain active on the books for just 1 full second before it could be canceled, doesn't that instantly kill spoofing?
It would kill it overnight.
Because a machine wouldn't dare place a billion-dollar fake sell wall if it had to leave it there for a whole second. Because a real institution might actually call their bluff and buy those shares.
Exactly. The risk would be way too high.
So if it's that simple, why isn't it implemented?
Because whenever a rule like that is proposed, the high-frequency trading firms deploy an army of lobbyists with a very specific, carefully crafted defense.
What's their defense?
They argue that they are essential liquidity providers.
Liquidity providers.
Yeah. They claim that by constantly quoting bid and ask prices thousands of times a second, they are the grease in the wheels of global finance.
Okay, I see the angle.
They frame themselves as this public utility, ensuring that whenever a retail investor wants to buy or sell, there is always a machine there to take the other side of the trade immediately.
I have to push back on that, though, because the data in these sources totally undermines that liquidity defense. It shows they are incredibly fair weather friends.
The forensic postmortems of major market stress events certainly paint a different picture.
Right. Because the sources look at what happens during genuine market stress.
Yeah.
The exact second there is real macroeconomic volatility, like a geopolitical crisis breaking out or a major bank failing. These algorithms don't stick around to provide liquidity.
No, they don't.
They're programmed to instantly unplug, pull all their capital out to protect themselves, and just vanish.
They completely disappear.
The order books just empty out, leaving human traders in a total freefall. It's like they take the umbrella the exact summon it starts raining. So how can they claim to be a public utility if they only provide a service when the weather is sunny and they're guaranteed to extract a microscopic profit?
They can't, logically. The data exposes the fundamental asymmetry of power in the market. The machines possess complete informational dominance, and they only play when the odds are algorithmically guaranteed.
It's a rigged game.
And the deep dive into the most recent research shows this dynamic is actually escalating. We are currently moving from pre-programmed algorithms to generative artificial intelligence.
Okay, that sounds like a massive escalation. What's the real difference between the bots we've been talking about and an AI?
Well, historically, a trading algorithm just followed strict logic written by a human quantitative analyst.
Like, if X, then Y.
Right. A human decided the strategy. If the price drops X%, spoof the MBBO with Y orders. But the major quantitative firms are now integrating deep learning neural networks directly into their trading code bases.
And neural networks learn on their own.
Exactly. They don't follow a script. They're given a single objective function, maximize alpha.
Which means maximize profit.
Yes, maximize profit. They are fed decades of market data, and they are left to actively invent new strategies entirely on their own.
So they aren't just looking for speed advantages anymore. They are figuring out how we think.
They're actively discovering entirely new ways to exploit human behavioral biases.
Give me an example of that.
So a neural network might independently discover that retail investors tend to hesitate for exactly 4 seconds after a 2% drop before panic selling.
Oh, wow.
The AI will optimize an extraction protocol based entirely on that specific psychological flaw without a human programmer ever telling it to look for that pattern.
Okay, so if my little trend lines and morning chart analysis are completely useless against an AI that is learning how to exploit my anxiety in real time, what am I supposed to do?
It's a tough spot to be in.
Should I just pull all my money out of the market and hide it under the floorboards? Like, if the system is this stacked and the regulators are perpetually 6 months behind, how does a normal person survive in an environment that is quite literally weaponized against them?
The defense requires a complete paradigm shift in how you view the market.
Okay, what's the shift?
First, you have to abandon the illusion that the current minute-by-minute spot price of an asset represents its true fundamental value.
So the price on my screen isn't real.
Often it isn't. The spot price you see on your phone at 2:32 p.m. is just a momentary intersection of algorithmic crossfire. Once you internalize that the spot price is an illusion, you change how you interact with the platform.
Which means rethinking the safety nets?
Yes. In an environment dominated by AI stop-loss hunting, placing a visible, rigid safety net at an obvious psychological support level is like publishing your exact GPS coordinates to an artillery battery.
You are broadcasting your pain point directly to the machines.
Exactly.
So the actionable step here is to stop leaving visible orders on the public book. You have to use mental stops where you decide on a price where you'll sell, but you keep it in your head.
Right.
Or maybe set price alerts on your phone and manually execute the trade yourself. You just can't leave your intentions sitting on a server somewhere for a supercomputer to read and exploit.
That's a huge part of it. And beyond the mechanics of the order book, you have to step entirely out of the microsecond arena.
I guess we can't win there.
You cannot beat a machine operating at the speed of light at a game of short-term volatility. The only way to neutralize their advantage is to operate on a timeline they cannot manipulate.
Okay, let me see if I'm tracking this logic.
Yeah.
An AI supercomputer in New Jersey is trained on order book data. It's looking at bids and asks moving in milliseconds.
Correct.
But it can't spoof a hurricane disrupting global shipping routes?
No, it can't.
It can't artificially manufacture a central bank interest rate hike.
Exactly.
So if I shift my focus to investing over a 6-month or a multi-year horizon, looking at the actual structural realities of the world, the bot's millisecond speed advantage becomes completely useless against me.
That is exactly the armor. A neural network can manipulate the tape for 10 minutes to force a panic, but it cannot manipulate the fundamental supply and demand of global energy over a year.
Right.
It cannot alter foundational shifts in geopolitics. You have to stop trading against the machines on their home turf and start investing based on reality.
Yeah, you have to take yourself out of the automated slaughter zone. If we refuse to play their short-term micro game, their speed advantage becomes completely useless.
Exactly.
When that sudden 7% drop happens on a random Tuesday, instead of panicking, you recognize it for what it is. It's algorithmic predation, hunting for weak hands. It's incredibly empowering once you see the strings actually pulling the market.
It really is.
But based on all the sources we've gone through, what is the final lingering thought you want to leave us with today?
Well, if we look at the trajectory of the research, you know, the speed, the spoofing, the transition to these autonomous learning neural networks, it points toward a really profound and frankly frightening scenario.
What's that?
These AI systems are currently learning to exploit human predictability. But what happens in a few years when the market is completely saturated with them? What happens when human retail traders are no longer the primary target? Will we see a day where two incredibly advanced competing AI supercomputers try to spoof and trap each other? What happens when one machine's deep learning strategy violently collides with another's, accidentally triggering a global financial cascade that is moving so fast and is so complex that neither human nor machine can pull the plug in time?
Wow. An AI versus AI flash crash that
Yeah.
breaks the whole financial system before anyone even realizes what went wrong. That is a terrifying thought.
It's the logical conclusion of the data.
And it totally changes how I'll look at the next glitch on my phone. Because that sudden, terrifying drop in your portfolio, it isn't a glitch. It's a reflection of the invisible war happening right beneath the surface of the tape.
Well, thank you for joining us on this deep dive into the sources. Keep questioning the data, step out of the microsecond arena, and whatever you do, don't let the machine see your stop loss. Until next time.